Hello viewers and welcome back to Dukascopy TV. I'm Natalie MacDonald. Up next we're talking Euro weakness. I'm joined by Patrizio Merciai of Gonet Cie. Patrizio, thank you so much for coming in.
You're welcome, my pleasure.
Okay, so Euro weakness. Firstly, how are investors viewing this circumstance and what are the subsequent implications in terms of inflation and also Euro area growth?
My God, first of all, Euro weakness is just a recent phenomenon. The euro has been actually very stable. Some people would say strong, but actually it has been stable. There's been very little volatility in both in equity markets, but on the forex market as well, except for a few emerging countries. So actually very little happened. And now we start to see the euro weakening, which was very much expected by investment community, simply because everyone knows that the Fed will be less accommodating, whereas ECB has been actually, and you can see it here, the Fed less accommodating, and the ECB with announcements 10 days ago of being a bit more accommodating. So this should bring the euro a bit down, and that's what has been unusual is that it was expected, but the market has been waiting for the confirmation. So it's not really a surprise. It happens the way it should happen, and actually it's good. It's good for growth in Europe. It won't be probably a major factor, It will especially help, maybe if we have time, we can discuss a bit more country by country or industry by industry. It could help, for instance, a country like Germany, which has been competing, for instance, directly against Japan. The yen had weakened in the past. But actually, this advantage is just one factor within many others. So, okay, it will support growth, but I think Europe and Eurozone growth has been recovering anyway. So it's a plus, let's say, it's a kind of boost to growth. Inflation has been very low. There's a lot of concern about deflation or whatever. But there's no deflation actually in Europe. There are no deflationary reactions, there are no deflationary expectations. Consumer spending, retail sales have been going up, consumer confidence has been going up. So with an easier ECB, with easier bank credit, because that's a goal of the ECB to achieve that, I think this will be a plus. So it's okay, it's very fine. I think it consolidates the recovery in Europe, but it's not a game changer, so to speak.
If we talk about then ECB versus Fed almost, is the US dollar the main beneficiary of Eurozone banks and investors dumping their euros? There was some discourse that single currency weakness could make gold more attractive, but the precious metal appears to have kind of traced the single currency downwards as well.
So you are giving me two options. So you're giving me answer A is dollar and answer B is gold. And if I may, I would use option 3 or option C, which is sterling. The main beneficiary, short term at least, has been sterling. This chart is a bit, it shows what? It shows that's a difference between what we saw earlier, stimulus from the Fed and stimulus from the ECB. And actually now that the difference is shrinking, it's bringing the euro back. Now, I could have drawn the same chart with the Bank of England, because at the same time, or I can't remember, one day later, after the ECB announced easing measures, Mr. Carney pre-announced or warned markets about maybe a quicker pace of tightening. So this gave a message that if there is one country or one central bank which is getting tighter sooner, that would be sterling. And as the economy has been growing anyway, this has caused, a rally in sterling, and it may last a bit. Probably some problems will happen down the road with external balances in the UK and something. But so far, the main beneficiary has been sterling. Gold, if interest rates worldwide are growing, maybe not rising, maybe not in the US, maybe not in Europe, but at least in the US and let's say on a world scale, you should not hold gold. I mean, the main enemy, the main deterrent of holding gold are rising interest rates. So they're not rising as much as of today, but that's written. I mean, the Fed will be rising rates next year. And so gold is not an option if we are in a decent, let's say, economic environment.
Is there a correlation between this euro performance and also European bonds and stocks outperformance? And how could that be set up to play out in the coming months?
Oh, okay. I think there's a relation which is the same cause as given rise to several effects, you know. And obviously, when you have central banks adding liquidity, you have more risk appetite. And with more risk appetite, okay, you are looking, for instance, for high yield bonds, you are looking for more smaller cap equities, and so on and so on. So this has been a bit of a general trend. Now, what's happening also is that, okay, this stimulus is, the purpose of this stimulus is to support growth. And with growth, we will get higher interest rate. We'll get higher cost of capital and we'll get higher interest rates. So I would be more cautious, let's say, on the bond markets, even though they have been rallying, than the equity market. And maybe this is a case in point. I mean, the scale is a bit dramatic. It's not a big move. But what you can see on this chart is that since the ECB announcement, is actually the spreads between Germany and the other countries within the Eurozone has been rising, because the spread has been very, very tight already. But it gives me a message that maybe, you know, it's a case of buying the rumor, so buying bonds before the announcement, and once you have the announcement, is selling the news. So I think probably this is done, you know. Most of the move in bonds is behind us. At those levels, you know, when you are below 1.4 on the German Bund or whatever, when you have the economy gathering steam, tentatively, but still gathering steam and so on. I mean, interest rates are cyclically too low, you know, so it's a danger. Equities, it's a different game. Equities, you have still the support of liquidity, short term, of added liquidity from the ECB, but you have also the earnings recovery. And okay, valuations are, let's say, in the middle or are still within their historical range. So I would say we are betting, and I think that's a medium-term play. We're betting much more on equities versus bonds at this stage. So I would differentiate between the two, even though both on the very short term are helped, let's say, by ECB decisions and euro weakness.
Patrizio, thank you so much for coming in and sharing your thoughts with us today. Thank you very much.
Thank you.
For more exclusives from market insiders, do stay tuned to Dukascopy TV. For now, though, it's goodbye.